Hi, welcome back to another edition of Lipper's Fund Flows Insight. My name is Tom Roseen. Thanks for joining me today. Investors injected about $15 billion into the conventional fund business. I think we're going to see that it's not actually in any of the areas that actually have any sort of return. We saw that there was actually some problems out in the market this week. There was really a disconcerted response to some really kind of cruddy news that we saw. First of all, we saw the Dow Jones Industrial Average post its first time it's posted a three-day triple-digit decline since September of 2011. Obviously set things off on stage. Well, what caused that? We saw that Greek authorities and also the Spanish authorities came out and were asking for more money. We looked at, found out that the Spaniards were not just having a banking issue, but they may even have a solvency issue. Secondly, we saw that the IMF, we're going to turn around and actually cut aid to Greece. And so that put kind of a pall over the party that's been going on over the last couple of weeks. Additionally, we saw that there was a change in the jobless claims, and in fact it had increased. Jobless claims increased more than expected, and that was a little bit disconcerting to investors. And last, Moody's actually cut their outlook for German AAA debt. Well, that doesn't mean that the German sovereign debt is going to be cut. It could be, but basically they're saying that the outlook does not look good because of Spain, Greece, Italy, and other nations that are having some fiscal problems going on, and they feel that Germany might be dragged down. Well, let's see how this economic data actually played through and impacted the flows into the conventional fund business. If we take a look at equity funds lost about $2.1 billion running out of their coffers. On the flip side, taxable bond funds took in $2.6 billion. We saw that muni bond funds continued on their merry old way, taking in about $0.8 billion. And money market funds, here's that area that didn't get a lot of good return, but a lot of money went in there. $13.7 billion went into their coffers. Now, this is something that we want to get a little bit more detailed on. So let's go ahead and take a look at our equity funds in particular to find out what happened in the universe. Equity funds actually had a decline of about 2.79% as far as performance goes for the week ended on Wednesday. It's the second week in three that we've actually seen negative performance, and we saw $2.1 billion come out of their coffers. This is the first week in three that we've actually seen an outflow. Domestic equity funds actually continued on their pattern, seeing about $1.9 billion in outflows. It's a pretty significant amount, but really I think one of the stories that I focused in on was the non-domestic equity funds. Only saw about $140 million, but it's their first outflow they've seen in 17 weeks. So while investors have been putting money away, they've been actually trying to put money into international funds. And this week they kind of said, you know what, European debt issue, China having some problems, we maybe want to pull back a little bit. So this is one of the areas that we saw. However, with that in mind, we saw investors take a look into dividend-paying funds. We saw equity income funds take in about $233 million, and they have been pulling in inflows in the last 63 weeks. They've only seen one outflow. So this is a trend we've been seeing for quite some time. But on the flip side, real estate funds, another dividend play, saw about $103 million. So while these weren't big numbers, they were really the only positive flows for the equity universe, and it certainly shows the trend of investors willing to go out on the risk to get yield. They're in search of yield. Well, looking and avoiding risk, equity ETFs is where we're going to be able to take a look and see what investors did this week. We saw $9.2 billion in outflows this week out of equity ETFs, and the lion's share of money came out of SPY. That's the S&P 500 ETF, where we saw $6 billion in outflows. We saw IWM, which is the iShares Russell 2000 ETF, lose about $1.2 billion in outflows, and certainly that makes up a good majority of what we saw. But again, investors are running for cover, and we saw that happen in ETF. Most of that's probably going to be institutional in nature. One thing we did see, though, is on the ETF side is that DVY. This is the iShares Dow Jones Dividend Payer ETF. Saw about $300 million in inflows. Not a big deal, but again, it continues that trend of investors willing to go out on the limb a little bit more in order to get a dividend payment. Well, let's look at another dividend-paying group, and that will be the fixed income universe. We take a look at our fixed income universe. We see that for the sixth week in a row, we saw inflows into this group, $2.6 billion as far as net new money coming into that group. And it's the second week in three that we've actually seen negative performance. This week we saw a downturn of about 0.36% as far as performance go. But here's the story that I guess that caught my eye. Here we had people ducking for cover, leaving equities, and generally we see that on the fixed income side, people becoming conservative. That was not the case this week. We saw corporate high yield funds actually taking $1.4 billion, and this is the 7th week in a row that we've actually seen them actually taking money. We saw corporate investment grade debt funds take in $911 million, and again, that's not a lot of money. It was kind of contrarian to what we thought we would see. We thought we might see some more treasuries and that, and while we saw a little money going in there, it was very little money. Really, people, again, were looking for yield. They were willing to go a little bit more on the risk spectrum and get that yield. Well, let's see what they did with the ETF version of the fixed income funds. We saw about $497 million of net new money coming into that group, and the predominant draw was from corporate high yield funds. They saw about $661 million in net new money comes into their things, and iShare iBox high yield took in $31 million. What we saw though was treasuries. If you take a look at this slide, treasuries were at the bottom, and 3 out of the 4 of the lowest performers as far as outflows go. Let's take a look at muni funds. Muni funds is an interesting group because they've had some interesting note as of late. We saw that the Wall Street Journal put out some notes on people actually doing selective defaults out of their governments because it might benefit them more. In the past, we've seen this as a safety play. So while we've seen people ducking for cover, we've seen people jump into muni bond funds, right? It's got taxing authority. They can come out and keep their yields quite high. It's tax exempt. But for the 6th consecutive week, we saw performance on the plus side, 0.51% return. It's the 15th consecutive week that we've actually seen positive inflows. But let me tell you, if we take a look at the 4-week moving average, we have 47 consecutive weeks where the 4-week moving average was on the plus side. That left us with only 3 weekly periods in that 47-week period where we saw negative numbers. So while we've seen a few negatives here and there, really the trend has been quite positive as far as money going into the conventional fund business of muni bond funds. Inflows were a little bit shy of $0.8 billion, and really the lion's share of money went into national munis, which saw $665 million of net new money. So that's something we're going to keep an eye on, especially with the most recent issues in Stockton and a couple other areas in California talking about maybe being comfortable with defaults. We'll have to keep an eye on that. Well, that brings us to our next group, and that was the money market funds. Well, money market funds are earning next to nothing in interest, right? And we're kind of surprised to see $13.7 billion of net new money coming into their coffers in this thing. This is the 2nd week in 3 that we've seen inflows into money market funds, and taxable money market funds took in $15.8 billion. Well, let's find out where the breakout is of that. Institutional funds actually put in 17.8, while the retail investor actually took out about 2.0, a little bit short of $2.1 billion. And tax-exempt money market funds actually saw $2.1 billion in outflows. So really we see maybe corporate treasurers parking a little money on the side, preparing for future payments in the next quarter. We're way ahead of that now. Quarter doesn't come up for quite some time, but certainly that might be some of the play there because, again, institutional investors were the big attendee as far as bringing money into money market funds. Well, one of the things we're going to keep an eye on as we go is basically, yesterday we saw that June durable goods orders were actually higher than expected. It came in about 1.6 versus 0.3. Had we taken out the transportation portion of it, we actually saw a little bit different of a game. But, June durable good orders actually showed that we're not in a recession. Secondly, this morning we saw Q2 GDP come out 1.5%, a little bit, again, lower than what people would, would want, a little bit better than the analyst expectations. 1.4 is what people were actually putting money on and saying what they thought it would be. But certainly, again, one of the things it shows is we're not in a recession. So while we come up to the dog days of summer for the next several weeks, we don't see a lot of movement going in and out of equity funds. But certainly, again, the dividend payers, high yield players are something that we're going to keep an eye on where we think money is going to be flowing. Well, if you want to do a little bit deeper research into the investment and classifications and maybe even the funds that you want to see who's been taking money in, go to our website. It's lipperusfundflows.com, and you can dig a little bit deeper, do a deeper dive. If not, you can join us next week when one of the analysts from Lipper will talk to you about the current trends in mutual fund flows. Well, thanks for joining me. My name's Tom Roseen, wishing you the best in your wealth planning and creation.